Hello and welcome everybody to this week's edition of Self Wealth Live, our technical analysis edition. Hopefully everyone's had a good long weekend. Jason, how was yours? Long weekend?
All pretty good, Rog. The sun came out and
we've lost him. Sun came out, we never came back. I think it's either him or me. So let's just see what happens if he's coming back here. We've lost him. You there, Jace?
yeah, no, I'm back.
I was just saying, it finished off on the sun came back, and then you never came back after that.
There you go. The internet still doesn't cooperate.
No, exactly. I think it's still coming off on holiday as well. So you went out anyway. You had a good weekend, good long weekend.
Yeah, so good. Always nice out in the sun. Got a bit of outdoor activity, and yeah, look, all ready to go again with some charts.
Very good. All right. Now, can I ask, Jason, obviously the ASX probably had a day off as well, right? Do you get withdrawals from not being able to have a look at, the charts on one day of the month? Or
this is the thing, Roger. There's always something moving. ASX was closed, but the rest of the world was still open. So there's always something to have a look and think about. But look, it's always good to not have a look and to think about it sometimes as well. It's the market isn't such that we should be looking at a screen all day, every day. And this is a great thing when you can take a medium-term approach. You can have a systemized approach that you can do the scans for what you're looking for and then go and do other things, which I do a lot of. So as much as I like to talk about, I'm always looking at the markets and thinking about them. It's not that I'm watching the screens all the time either, because we do have these systemized approaches that we can just let run and take the emotion out of it and keep the consistency there and free ourselves up for other stuff.
Okay, fantastic. Actually, talking about systems, I've got a bit of a question for you coming up very soon. And talking about questions, obviously, everyone who knows the drill, or obviously put your questions in the chat and we'll get to them as best we can. And then near the end of the show, we're also going to have a look at tickers that you guys want us to have a look at from a technical analysis point of view, from a charting point of view, right? So before that, we'll also go through the markets in general, the AU, the US and the Hong Kong markets. All right, everyone. Welcome everyone here to today. Once again, we appreciate you coming here. Jason, did you want to put up the disclaimers, please?
Absolutely. So everything today is general commentary only. It doesn't take anyone's personal situation into account. And just a quick look at that disclaimer. And also, I'm not part of Self Wealth. I'm Motion Trader. That's my business. And so you can see the details of my licensing, everything up the top. And then below there, you see all the Self Wealth information. And as I say, general commentary only.
Thanks, Jason. My name's Roger, if you didn't already know, and I am part of Self Wealth. So if you've never tried our platform out, obviously there's links below, and you can grab yourself 10 free trades. Not to mention that it's $9.50 brokerage. So if you're with a bank, then hey, you might save yourself a few dollars if you decide to switch. All right. So So let's move on with the show now. Jason, the ASX looks like it's coming off a little bit today. How's it looking overall?
Yeah, so let's just jump over. So this is the ASX 200, and first up, look, this rally we had through the last week or two is actually, I think, quite constructive. The buying came in just around the right time near this 100-day moving average. So I've got the 50-day, that's the top average, and then below there, that's the 100-day moving average. And just below this 100-day moving average, the buying started to come in, started to see the market push back up. Briefly had this break below support. You can see this vertical blue area, shaded area around 7,720. Got a break below there a couple of weeks ago. I thought that might have led to a bit of a deeper pullback. I thought we might have seen levels down towards the April low, but as I was saying about that buying coming in earlier than I thought. So I think that's constructive, and that's what you want to see. You want to see the dips being bought, and that's really been the story over the course of this year. Like all these pullbacks, the dips are getting bought. That's always a sign of a constructive market, of a market which is in a broad upward trend, which is very different to when a market is below declining moving averages. Then it's a case of, the rallies are being sold. The rallies get sold. We're getting the opposite now. We're getting the declines being bought. So I think that's a good thing. A key feature on this chart is this trading range, which I've drawn in. You can see these blue converging lines. So we've got enough data there now, I think, enough price action to be able to draw this lower line in just with this rally over the last couple of weeks. So it gives a nice visual on one of the things we've been talking about over the last few weeks, or last couple of months really, since the market hit its high in March, came back down, broke the 50-day moving average. In mid-April, we started talking about the possibility of a longer consolidation, and we can now see that. We've now got that nice visual of the converging lines on the chart, which really start to firm up that range. And there are two types of trading range we often see in the chart. One being this contracting range, and the other being more of a rectangular range. But yeah, on this occasion, we're dealing with with this type, the contracting type. And ranges are really a bit of a equilibrium period. It's where the buyers and the sellers neither's really dominating, and it's not until we get a breakout from the range that we see a new trend emerge. Now, ranges, they don't always lead to a new trend initially. Sometimes we get a false break. We'll get a break to the downside or a break to the upside, and it won't stick and it will come back. But often what we see is when a market breaks out of these ranges, we do get a new trending period. So that's what I'm watching now. I'm watching how the price is coiling up, and it's a waiting game. It's waiting for the market to show its hand with a break one way or the other. I think it's to the top side ultimately, but of course we don't know. We wait for that breakout. What's good here is we do have some clear levels to watch. So on the top side, we've got the May high, the April high. On the downside, it's the April low and the May low. Really, just along these trend lines, and just also keeping an eye on this support around 7,700, where the market's just pulling back to now. It'll be interesting to see whether we do see the ASX get some support around current levels, around this 50-day moving average as well. That would be a natural place to get some support. So yeah, we'll see how that plays out. I think the underlying trend here, Rog, remains bullish. My approach through this whole period, the last couple of months, it's really been, as we've been saying, the approach is, from my perspective, it's been to remain long, and that remains the case now. I'm using those wide trailing stops that I often talk about, try and see off the consolidation that we're getting in the market, that we're getting in a lot of the individual stocks. I'm trying to stay with profitable positions, not get shaken out during this sideways period in the price action. That said, though, I'm also selling stocks when they trigger an exit. I've sold a handful of stocks in the last couple of weeks, not much, but it's just that thing I think about always having that exit strategy. I think it's the most important thing. Well, it's one of the most important things that I think we can do is protecting capital. And when we protect capital, we really do. One of the problems for a lot of people is they don't protect their capital, they renounce, and the problem with that is, well, you lose your seat at the table. So we've got to have that exit strategy for when things go amiss. But for me, I think this is still a constructive market. As I say, I'm still long the market. I want to be long, and it's a waiting game for this consolidation to play itself out.
Yeah, it's definitely a patience game in the ASX at the moment, and I don't know why it's normally the ASX does similar things to the US, but the US is different. Let's have a look at that. Obviously, it's like a different structure.
Yeah, well, look, it's a fascinating situation what's going on in the US, because like I got the S&P 500 here, and it's hitting a new all-time high. You can see this structure over the last. Well, there's the April high, which we have in the ASX 200, had the initial decline, but whereas the ASX 200 rallied and then peaked and pulled back again, the S&P 500 has continued, and we've got these new all-time highs. It's constructive that it's rallying off the 50-day moving average. So again, I've got the 50 and the 100-day moving averages. And it was the same back in April. It was positive, I think, also that the market came back to this time. The 100-day average rallied off that. The 50-day average rallied off that. So from this perspective, I think it's a simple case of staying long and letting profits run. I think the more interesting situation is, do you buy into this latest break to a new all-time high in the S&P 500? Now, I'm normally one who says, look, you buy into strength, the trends are the path of least resistance, but there's a bit of an interesting twist with how the S&P 500 is trading. I'm going to jump over to another chart. So this is the S&P 500 index, which is market capitalization based. So that means the biggest stock has the most influence, and the 500 stock in the S&P 500 has the least influence. What I'm going to do, I'm going to jump over to an equal weight version of the S&P 500. So this is where the biggest stock and the smaller stock have the same influence. You can see it's quite a different situation. Actually, it looks a bit more like the ASX 200 in that we do have this coiling situation, and the highs we're seeing in the S&P 500 aren't being replicated in the S&P 500 equal weight. And you can see the current prices is below the May high, below the April high, and we're also just sitting down here on the 50 and the 100-day moving averages. I think, look, the overall structure here, I think, is positive. I think it's all constructive. But the point to make is that this is still a range-bound market, and that's been the case for the last 2 months, like we have locally. We don't have that upward momentum across stocks generally. And then you go, well, look, why is that? Why is the equal weight look like this and the S&P 500 look like that? And it really comes down to one stock, Nvidia. It's making new highs, and it's really pulling the S&P 500 along with it, and we're not seeing that in the equal weight. We spoke a bit about Nvidia last week. It makes up about 6% of the S&P 500, and it's up about 30% in the last 3 weeks. Just last Wednesday, it was up about 5% alone. So we rarely see such big moves in one stock, but we're seeing it now, and that's really having an impact on the S&P 500. In fact, I saw something interesting last week. About half of the S&P 500's gains, so look at the S&P 500 this year, about half of these gains is due to Nvidia, which is really quite extraordinary. And you're not seeing this in the equal weight because Nvidia only makes up 1/500th as opposed to 6% or so. So it's not having that impact. Another interesting stat I saw is that for the S&P 500, about the average stock, the average S&P 500 stock is about 12.5% below its 52-week high. So where the S&P 500 new all-time highs, it's not the case for the average S&P 500 stock. So yes, the S&P 500 is at all-time highs, but I don't think it's so much a case of a booming market at this very moment in time. It's more a case of one stock booming. So I think if you buy the breakout at the moment in the S&P 500, you're in a large part piling into Nvidia after this extraordinary run. That's why I rather use the equal weight just at the moment as a broader measure of what's going on internally in the market. Like I was saying with the ASX 200, I'm long stocks. I'm happy to let profitable positions run. But it's just worth being aware of what one of the big drivers of the S&P 500 is at the moment, and that to a large extent, a lot of the S&P 500 is still range bound. And again, I'm using those wide trailing stops. They're useful in these range bound markets because they can sit below the price action, let the market consolidate, do what it needs to do, and then potentially we get another upward leg. Potentially this breaks higher, follows the S&P upwards. And just staying in there with those wide trailing stops. Other thing I'm doing is just being patient with buying. It's about waiting for the right setups. Because as I was saying, not every stock is hitting new highs at the moment. So just wait for the setups, wait for the price action. And at the moment, most stocks aren't hitting new all-time highs, at least not yet.
It's amazing what one stock can do to such a massive market that America is, the biggest probably capital markets in the world, right? So it's just absolutely amazing. And I saw the same picture. If you compare the difference between the Nasdaq index and the Dow Jones, right? The Dow Jones in the middle of the range, and the Nasdaq is hitting all-time highs, right? So
yeah, well, here's the Dow here, and the Dow's not confirming these new highs either. It's a few percent below its highs back at the moving averages. Again, not dissimilar to the ASX 200, not dissimilar to the S&P 500 equal weight. And the reason the Dow's not playing is that the Nvidia is not part of the Dow. It's not part of the Dow 30, so it's not having that influence. But of course, it's in the Nasdaq and it's in the S&P 500. So those indices are really being pulled upward by Nvidia. But I think to get that broader picture of what's going on across the market generally, have a look. What's the Dow doing? What's the equal weight doing? What's the Russell doing? None of those indices are hitting new highs at the moment. It's not a bearish thing. It's just to say that the market is currently not hitting all-time highs. So it's a little bit distorted, I think, by the extraordinary gains that we're seeing in Nvidia.
And maybe just to go off the point here, and let's have a look at Michael's question here around having a look at the difference between Apple and Microsoft against the SPY and putting Nvidia. Can we do multiple price charts on one?
Let's have a go. Okay, look, let's put Apple in, and let's put in Microsoft, and now we'll put them onto let's try doing the same percentage and see what we get when we do that. So there we are with so Microsoft is well and truly outperforming Apple at this point. Now let's put in Nvidia. Now there was an issue with the Nvidia's data when I looked at it this morning. There's a spike in the
I'm hearing news of a stock split or something. So yeah, I've heard something might be happening with the stock. So it might not be the best view at the moment.
Yeah. Actually, that's worked okay because this is working on closing price. When you looked at the high close from yesterday, It was just like there's a bad bit of data in there. But that's okay. It's not showing up here. So well, look, that tells you a lot. Let me just take that off for a moment. Doesn't that tell a story? Yeah. In that there's Nvidia, there's Microsoft second, and there's Apple, which was the stock everyone spoke about. Was it last year and 2022, 23? It was all Apple was all the rage, and now the story is very much Nvidia. You're just looking at that over that's probably a couple of years, and the other two are basically flatlined. When you look at it on that scale, that's not the case. They're both up considerably. Apple's up 24%, Microsoft's up 87%. Rarely do you see an 87% gain looking like a flat line. But this is causing this distortion. This is what I think. I think this is causing the distortion in the S&P 500, where it looks like the market's booming, but it's Nvidia. It's the single stock boom. It's not. And again, I'm stressing. I'm not saying the whole market is struggling. It's just going sideways to a large extent. But Nvidia is really causing the a bit of gain there. We can also just put in the S&P 500 as well. Single. There we go on the percentage basis. And where is it? I can't even. It must be the red line. So yeah, there's the S&P 500 down here. It's up 4%. Oh, that was on the time frame I was looking. I've just moved the charts again. But yeah, it's you really can't see too much of it. Let me just take Nvidia off. Maybe we try taking Nvidia off and seeing how it all then looks. Now you can see everything. So again, you can see. I think that really helps demonstrate how much distortion there is from one stock. This line down the bottom would be the S&P 500. Then we've got Apple in the middle, and we've got Microsoft at the top. And you know what happens when you put Nvidia back in, everything else pretty much disappears. So very interesting situation. yeah, it's going to be interesting how it all plays out. I like the individual stock approach at the moment rather than just buying the S&P 500 outright, because it seems to be so much as being influenced by Nvidia. I'd rather go through, look at the individual stocks, buy the breakouts, buy the rallies off the moving averages, rather than pile into one stock after it's been, like if I was in Nvidia, I'd certainly be holding it, let profits run. But it's a harder point to come in and buy now after such a strong run. I think that's what someone's doing if they buy the S&P 500 index for the first time at current levels. They're coming in after that big run in Nvidia.
Yep, I'm still spewing. I didn't know about share trading when I was building computers 30 years ago with Nvidia chips and all these things. Jeez. Anyway, before we get on to the next few questions here, maybe let's have a look at the. It's a great picture, that one though, the Nvidia, graph just showing a huge boom compared to the other big few tech stocks there. But let's have a look at the Hong Kong market then next.
Look, pretty quiet here generally. It's largely just been a sideways movement over the last couple of weeks. A little bit of weakness coming through today, back towards the 50-day moving average. Ideally, we see the Hang Seng start to stabilise around current prices, around this 50-day moving average. If it can stabilise around here, well, then maybe we start to see a bit of a base form. And then from there, we can consider, well, is that a base that can support higher levels? At the moment, I'd be keeping a bullish bias towards it, but it's still early days. It's coming off a lengthy period when we just compress this. It's been a horrid few years. There's no guarantee by any stretch that it's over now. We're just seeing signs of the potential for further upward momentum to build. It doesn't mean it's going to happen. So this is why we want to see how it consolidates here. We've had these initial two moves up, and now let's see if it can consolidate at current levels, show us signs there's accumulation happening, underpinning the pullback. Well, then we start to look at the possibility of okay, well, can it leverage off that base and go for another run? But at the moment, it's a case of, if I was in this from these initial breakout points, I'd be staying in. I'd use a wide trailing stop, see if I could see off this consolidation, see if it goes for another kick. If it comes back, maybe it would stop me out. If I was in, I'm not in this market. But that's how I'd play it. I'd risk giving back an initial gain for the chance of a much greater gain if the rally starts to take hold. But at the moment, let's just see how the consolidation goes. Pretty much the same over in China. It looks pretty corrective, although today it's just starting to, just like in the Hang Seng, we are starting to see some more weakness come through. It's now testing the 100-day moving average. I'd really like to see it start to stabilise really quickly now and start establishing a bit of a base around the 100-day moving average. If it starts to peel away and we start getting down below the mid-April low, well, then it starts to open the question, well, look, was that just another bear market rally, and maybe new lows are coming? But we're not quite there yet. At the moment, I'd still be giving the benefit of the doubt to the potential that we do get some sort of larger turnaround underway. But it really is a tentative situation, and I think we've got some levels to watch here: the 100-day moving average, and also this low from April. If it's going to stay bullish, I think it really should start to attract some buying interest pretty soon.
Yes. All right. Very good. All right. Let's have a look at some questions here. From Michael. How do you use stops in a range-bound market? Where do you place the stops?
In a range-bound market, well, often it's a case of staying out of a range-bound market. It's like, and like there's indices, looking at indices and looking at stocks is going to be a little bit different. It's similar. Like for instance, so different ways you can play these things. So like someone might say, look, I'm bullish on the ASX 200. So it's just pulling back towards support today. So I might buy it here, and I could put a stop loss just below the lower boundary of this range. I don't think that's an asymmetric play because you're kind of buying it in the middle of the range. But just for the sake of trying to like talk about how you'd use a range. So really the play would be, you tend to try and want to buy things towards the lower end of the range, and then you can have a stop loss just underneath the range. So it's a relatively small stop, and you're working on the basis that it's going to find support, buying will come in, buying the dip, and then push it back towards the upper end of the range. Some people just specialize in trading ranges. They like to buy the bottom of the range and they take profit up around the top. It's not what I do. I prefer to buy breakouts from ranges and then let profits run. But that's the thing with trading markets. There are so many different ways to do it. There's not just one way that works for everyone. Different ways you can play it. But yeah, the way you use a stop loss within a range would often be, if you're buying within the range, having the stop loss beneath the range. If you're buying a breakout from the range, having a stop loss back within the range. That's briefly how I would use stops and ranges.
Yeah, and because obviously if you're buying on the breakout after a range has happened, you're probably putting your stop loss underneath the most recent sort of low within that range, right? That could be a point where you could put it, right? It's but yeah, I don't know if you want to elaborate on that.
Yeah, I'm just trying to think of examples and ranges. So one that comes to mind was a little bit ago in the Russell 2000. It's the US small caps, and it was quite a distinctive, quite a pronounced range. So the market had this big rally, and then we went into this large sideways period. So that was the range, and then there was a breakout. It turned out to be a false break, and then the market fell away. And we get false breaks. You get a false break. It's not to say, buying a breakout from a range doesn't work. It can work spectacularly, but it doesn't work every time. This is why we use stop losses. We use risk management. So had someone been buying the breakout from this range, like I can just firm that up a little bit more, so it's kind of, you can see these previous highs broke above the previous highs. So then a play would have been, okay, put a stop loss back within the range. Just say where that blue line is, for instance. It's like not having it like right really snug up underneath it, because often you will get a market which will come back, just test back within the range, and then rally again. So you've got to give it a bit of leeway. So you've got to work out your percentages with each one, but that's just visually like how I'm giving it a little bit of room back within the range. So maybe I was theoretically, maybe I would have had like a buy order at the top blue line and a stop loss at the bottom. So I would have taken a relatively small loss. Didn't work out, but had it run, well, then the potential was there to make a significant profit with a relatively small amount of initial risk. So that's how I'd play the breakout from a range.
All right, fantastic. All right, let's have a look at a few stocks right now. Then let's have a look. Start off with IDX, please.
So let's see. With that, might not be the right. Is it the an ASX listing? Is that all we have? IBX?
IDX, D with a D.
Yeah, okay, that will make a difference. Because IBX wasn't looking like something we wanted to be in. Okay, let me just compress this and get some background on it. So a stock which had done really well, and again, why we don't just hold, this is just an example of why we don't want to, why I think we shouldn't have great loyalty to stocks which have done well for us. So someone could have done really well from this stock, from the COVID lows, but then you say loyal to a stock which has done well for you, you can also then give all the money back. So this is why I always talk about a trailing stop. So a trailing stop will follow up beneath the share price, won't get you out at the top, but it can get you a long way. You can get a large part of this move, but then at some point around where I'm moving with the cursor, it gets you out. So you avoid holding on for the decline. But now we've had that decline, looking at it now, it's not a dissimilar sort of setup to what we have with the Hang Seng and the Chinese market, and that this large decline, and now we've got this tentative sign of an upward trend returning. Whether it kicks, whether it really gets to hold its footing and push on, time will tell. But there is initial signs is that there's upward interest in this, or buying interest in this stock appearing, giving it the upward momentum. From below the moving averages to now being above the moving averages of cross, so they're all positive things. It's now coming back and consolidating around the moving averages. If I owned this stock at the moment, I'd be holding it, and I'd probably have a stop loss back below the 100-day moving average. Maybe it's different widths of stops you can use depending on how aggressive you want to be. But one strategy would be back below the mid-March low, having an exit point there. So that is that's about 16% below the market. If I wasn't in it, I wouldn't buy it at the moment, because I want to see how this consolidation plays out. I'd rather buy this into strength, because it's not enough of an established trend to give me confidence in buying this dip. I'd rather probably buy a breakout, maybe above the April high, as a potential entry point, and then having a stop loss back below maybe the 100-day moving average. So it's a stock which we could see an upward trend develop, but yeah, like I say, with that Hang Seng and Chinese market, it's tentative at the moment. We don't know whether this is going to stick.
All right, let's have a look at BOE. There's a question there from Martin. Comments on BOE, it's close to stops, but there's an artificial reason for the recent decline, directors selling, but long-term uranium thesis seems intact.
Yeah, at the moment it really does look like you could almost call this like a bit of a zigzag consolidation. It hasn't come too much below these previous lows. You could still be calling this a trading range of sorts, but it would need to hold current levels and bounce pretty soon, or it's no longer really a trading range, because it starts to get to the lower end of the range. At the moment, it does look corrective. This is a tricky part for people to decide, like what to do here. How much more room do you give this? Like, the longer term uranium viewpoint, like, what do you think of uranium longer term? Like, we can say, look, we've got this really, uranium may have these great fundamentals over the medium to longer term, but it can be hard to trade an individual stock based on that alone, and that may not even play out. So we've got to be aware of our price action and where we say enough is enough. Like, it so much depends. Like, if someone bought it at the high in February, well, it's probably getting to a point where you've got to say, well, look, this is currently not working out. I'm down 30%. How much more can I give this? Probably not much more. But if someone's in from back when we had these breakouts, you can see it's had various breakouts over the last year. If you're in at better levels, well, then there is probably a little bit more leeway. But we do need to be mindful when a stock is getting below these moving averages, the moving averages start to roll over, what to do with it. Do we manage risk, or do we just say, look, I'm holding in for the long term? I think it's dangerous saying, look, I'm just holding in for the long term, particularly with an individual stock. If it's an ETF with a collection of stocks, maybe you can say it's a longer term situation. But with an individual stock, I think it's harder to do, because situations are more likely to change with an individual stock. They can have their own situation where something goes wrong with the mine, or they don't get an approval, or their they disappoint the market in some way, and this stock or an individual stock does something different to the uranium stocks generally. I'm not saying that's going to be the case with BOE. It's just a general comment about knowing where an exit is in an individual stock.
Mm-hmm.
At the moment, I think the overall structure looks fine. But I think I'd want to have an exit point. I'd want to know where it is. And I can't tell you where to put it because I don't know. I'd be probably using my 10 ATR stop to help me work out where an exit in BOE would be.
Yeah, if you entered in that breakout just after June 23 there, would it have hit your ATR stop by now?
No, 10 ATR. Well, we can put one on. Let's just quickly put on a 10 ATR stop. This one is a little bit different to the one I use, but it's similar. I've made a few modifications. I think it just helps how it works, but it gives you a good guide. So I'm going to change the multiplier. The multiplier of this is 3. I use a multiplier of 10, so it's 10 times the ATR, or the average true range, which is essentially the average daily trading range. And when we do that, so the ATR stop comes in at around 388. So it's got a bit more room to move around. Mm-hmm. And the idea of these wide stops is they can help see off large periods of consolidation and stay on a trend. And the cost is that you give back more at the end. Then if the stock kind of gets going but doesn't really get going, you're probably not going to make that much out of it. The wide ATR stops really come into their own when you get these big trends that might go for 1, 2, or 3 years, and the stock goes up triple digits, and sometimes big triple digits. That's when these wide ATR stops really pay off. But you get plenty of stocks which just a decent gain just kind of mostly turns into a modest gain, and that's. Nothing's perfect. We can't pick the highs, so it's like use those wide stops, let it go where it's going to go. If it goes a long way, great. If it doesn't, well, you just move to the next one.
All right, let's have a look at CHN, please.
Yeah, I was looking at this the other day, and it's interesting. Is this going to turn into something? So this has been in a large decline for a couple of years. Just looking at this, the price action looks constructive in that it looks like it's stepping upwards. So you step up, then like a half step back, another step up, a half step back, another step up, half step back. So it looks like it's trying to build, but is it going to actually be able to break away? That's what we don't really know at the moment. It's still early. The moving averages still haven't crossed, so the 50 hasn't got above the 100. Come right back to the moving averages now. So now is a pretty key point. Like, is it going to be able to find support or buying interest pretty soon? If it doesn't, well, there's always a risk that then it just continues back down to its lows. So if I had been buying into this, like I could have been using 10 and 20-day moving averages, probably would have got like an earlier entry point. I just want to be, I wouldn't give it an endless runway. If I was in, I'd be thinking, okay, where do I get out if it doesn't start to find support pretty soon? If I was looking at buying it, and I have considered this myself, I think I'd be looking. I'd want to see some strength develop and maybe a break above the May lows. Just start getting some more upward momentum into this. Get the moving averages crossing. It's one of the couple of things I've been looking at. I've been looking at a couple of ETFs in the US just as a guide for this rare earth lithium sort of space generally. So this is a rare earth ETF listed in the US. It's a Van Eck one, and I thought it had this like upward stepping structure, a bit like we're seeing in Chalice, but it hasn't been able to hold its footing, and it's given way, broken down from this little wedging type of pattern, or what you'd call it an upward sloping flag maybe. It's broken down from that. The moving averages are still trending lower, so it doesn't look like it's ready yet. And then the lithium. lithium and battery ETF. Again, we've got this holding pattern. It's testing the lower boundary of support. So is this going to be a basing structure or a continuation structure? So basing, well, we know what that means. It forms a base and goes higher. Continuation is where the market declines, has a breather, and then breaks lower again. That's a continuation pattern. It continues the previous trend. I don't know which one it's going to be. But I'm watching it to see whether an opportunity presents. At the moment, it hasn't presented. So that's a situation with Chalice. It's something which is worth keeping an eye on, but I don't see the green light for it just yet.
All right, let's have a look at DRE, please.
Yeah, it's probably not one for me in that. Well, the downtrend's still in place. It does, like, it's lost its downward momentum at around 1.5 cents, and you'd hope it would lose its downward momentum at 1.5 cents because there's not much more runway left. But whether that means it's going to go back up, I don't know. Not everything that goes down goes up again. Some stocks go out of business. Some stocks just grind along the bottom for years. But then some turn themselves around and start to rally again. But it's like you say, look, I want to have a speculative trade in because I like something that they're doing. You just work out the risk on it. So at current levels, you buy at current levels and you put your stop loss at a new low, and it's 35% down to a new low. So look, for something which is probably highly speculative, maybe your reason a 35% stop loss is reasonable, given upside potential could be 100% or more. But for me, it's just too speculative. I can see how you could manage risk around it. So that scenario we just went through, say 35% of risk versus 100% plus of upside. So you can argue there's asymmetry in that setup. But is it going to play out? I don't know. I prefer trends that are becoming more established rather than just trying to punch something off the low. But if someone really liked the company for some reason, there's a pathway there to take on some risk.
All right, then TSO, please.
TSO,
yep.
Yeah. Okay. So look, there's signs of an emerging trend. We've gone from below the averages to above. We've got rising moving averages, pull back to the 50-day moving average. If somebody wanted to speculate in a stock like this, we could say one scenario would be buying at current levels, putting a stop loss maybe 25% below, so below the 100-day moving average and a bit more. And if it holds these moving averages and rallies, well, it's one of those stocks which again could be up 100% in not too much time at all. But of course, it's one of those more down the more speculative end. But it's one I like that you can manage the risk around it. It's more of an established, or it's more, the trend is more further down the line in its emerging status than Dreadnought, which really isn't down the line at all. It's just a bounce off the low, whereas this would move from below averages to above, pulling back to them. It's I think it's a stock of interest which we could see some more upside in.
Okay, very good. MNB.
Was that MN?
MN, N for Nelly, and then B.
Yeah, look, it's sitting below those moving averages. No, I wouldn't play this one. You can manage the risk around it. You can say, look, buy at current levels and just put a stop below the recent low. So it's say risk 10%, but it's just such a punt because you're punting that you're going to pick the low. which is just such an elusive thing. It could well stop here and rebound. It may just rebound to the moving averages and then roll over again. So there's just not enough. It's just like, well, like you got this period here. We've got a little bit of a double bottom, and we got a rally, but it didn't last and it gave it all back. So you say, oh well, look, I could have taken profit after a few days, but that's just such short-term trading, and it's such a hard game to make money doing that over time. You can get a few wins, but to consistently do it and repeatedly do it, I think it's a lot harder, particularly when you're buying things which are in downtrends, hoping to get bounces. So I don't think that's a way to make a repeatable process that's going to work for you well over time. And this is why I'd leave this one alone. Yes, you could get at current levels. Yes, it could bounce, could get back to the moving averages, could get above, could be the final low. But I think the odds still favour that this one would see more downside.
All right, let's move on to Neil's ticker here, which is LTP.
Is this the right one? LTP?
Yeah, I believe so. That's the ASX one. Yeah.
Yeah. Yeah. Well, great. If we're on this, it's I'd certainly, if I was on this, I'd certainly be keeping it. I'd be letting the profit run, see where it goes. Harder one to buy though, because it's so stretched above the moving averages. It's like 60% above the 100-day moving average. So where do you manage your risk if you were to buy it at current levels? Maybe put a stop back. Like, you know, you're looking at like nearly 40%. Just have a stop below this. Like gaps in the share price often provide an area of support. So the market might come back to the top of the gap, find support. But then if you say, look, I'll put a stop at below the bottom of the gap, you're looking at around 40%. And so it's a hard one to justify buying, just from the perspective that it's hard to know how to manage your risk on it. But absolutely, if I was in this, I'd 100% be holding it and using that wide trailing stop and see where it goes.
All right, and let's have a look at the PSQ.
So this, I think this is a takeover situation because the shares have just basically stopped trading. I've got some of this myself, so I should know, but I don't know because I haven't looked at the fundamentals of it. If it's a takeover situation, I'll get a note in the mail saying, yeah, it's being taken over, and I'll sell the shares accordingly. But I assume that's what the situation is. I think it must be being taken out. You can see how the share price is just so much different to everything else on the chart. That's typical of a stock which is not going to be trading on the exchange for much longer. But you need to just check that is actually the case.
I was just reading the news. Pacific Smiles Group acquisition cleared. Yeah, maybe you might be onto something there, but yeah, it hasn't been data on that since still 11th of June. But yeah, obviously have a look at maybe ring up the company. I'll figure out what's going on there.
It'll be in the ASX announcements. Just go into the ASX. So you just Google ASX space PSQ, and you'll get the ASX. Get a link to the ASX announcements page for the company, and you'll just get the update on what's going on. So from what you just said, Rog, there's a takeover in play. And this is typically what happens. The share price will continue to trade until the date which will be listed. It'll already be listed. Probably be already listed. The date trading will be suspended, pending delisting and the acquisition of the company into the acquiring company. And it's then a case of do you just fill out the paperwork and accept the offer, which could well be all cash, but you need to check that. Or do you sell on market at current prices? And and that will. But it would appear unlikely there's any more upside in this one. Things can change, but yeah, there's probably nothing more to see here.
Very good. All right, let's have a look at a US listing here, CVNA.
Yeah, so big uptrend, big downtrend. Again, what we were talking about earlier, why we use trailing stops. You want to get the upside, but you want to be able to jump off so you don't hang on for the slippery slide down, which does happen. Does happen quite a bit. But that was then, and this is now, and the structure's changed from being below the averages to being generally above. So if I'd gotten on this one, I'd be staying on it because we do have there's upward momentum. So let's see where the momentum goes in terms of buying it. So like it could be a case of like what we saw in March, where we had the rally, came back to the 50-day, between the 50 and 100-day moving averages and rallied again. We could see the same situation play out again, and we saw something similar back in January. If somebody really liked this stock for some reason, maybe there is a case where it's bought at current levels, and a stop loss could be, yeah. Look, I'm probably not so keen just buying it at this point. I'd rather see some more structure in the price action. But look, this is one I'd look at positively. We're saying, look, if I can see, maybe if we can see a range develop or some sort of a base, there's a case of buying the breakout from that consolidation. That's probably the way I'd like to play this one, rather than just buying because it's come back to the 50-day average and bounced for a couple of days. Sometimes you don't get a setup which makes sense to jump on board. Sometimes you get a really nice clear one where you can manage the risk around. So that's the way I'd play it. I'd be watching this one if I wasn't in it, but if I was in it, I'd be staying on, wide trailing stop.
Okay. GQG, sorry.
And upward trend remains in place. And this is a motion trader stock, this one. I think the original signal must have been after the averages crossed, broke to a new high. And this is why we let profits run and just see where they go. Just compressing this, let's just, this is when it listed. So it's still a relatively new company. Yeah. For me, if it was in my portfolio, it's the same thing I often say: let the profit run, use that wide trailing stop to see off the inevitable pullbacks which are going to come. So my trailing stop would be below the 100-day moving average, just giving it lots of room to move around. And I'm trying to stay in these stocks for maybe 1, 2, or even 3 years and get a much larger trend. In terms of buying now, well, look, it's making a new high. It is a reasonable buying point to buy a stock as it breaks to a new all-time high. A lot of people find that quite unnerving, going, "Why do I want to pay the highest price ever for a stock?" But when you test these things out, buying at an all-time high is a better strategy than buying at an all-time low. It's stocks that are hitting new lows tend to continue to hit new lows. Stocks that are hitting new highs tend to continue hitting new highs. Now, at some point, that can flip, and often does flip, but a stock will keep making new highs for much longer. So it's just going with that path of least resistance, which at this time is the upside. If I were to buy it here, I'd have the stop back below the. I'd probably have it. Look, you got those two lows from late May. More aggressive stop would be probably just below these levels from May, giving a bit more room back below the 100-day moving average. But yeah, at this point, trends up.
Okay, fantastic. What about COL?
Let's see. So hasn't done much for a bit, has it? We've got this big range that has played out since 2020, and it's interesting because you can kind of put the So it's sort of like broken down from this range, but it hasn't really followed through on the downside. It's like sometimes ranges look really clean, other times they're a bit messy, and this is a messy one. So like getting that false break higher in 22, then back within the range. Now we've got a break to the downside. So this one's just messy. I think you can make a case that going, okay, well, it's tried to really break to the downside, couldn't get the follow through momentum, and started to move higher. So from that perspective, maybe this is an opportunity in the making. I think there's probably better ideas out there at the moment, in that we've had a really good rally in the market since October, and Coles hasn't really participated much in that rally, so it showed relative weakness. Let's just see how much it did rally off the lows. It's only 13% off the lows. The ASX 200 was up a lot more, so it is a relatively weak stock. So my preference would be to go to a stock which is showing relative strength, not one which it's just kind of like the rising tide is kind of lifting it off the bottom. I'm not enthusiastic about it at this point. If somebody really liked it for some reason, I guess, like I don't even want to say buy it now and just put a stop below the recent low. Look, it's only 6% or so, so that's a strategy. Buy at current levels, stop below the recent lows. But you could easily see this stock continue to pull back and go sideways and just be a bit messy. So yeah, sometimes some things don't stand out, and at the moment, unfortunately, Coles doesn't really stand out. I'd probably just leave this one alone.
All right, we'll do last couple here. ORI.
Yeah. So I spoke about this a few weeks ago, and it was an interesting one because this has been a stock which has been out of favour for so long. I'll just quickly show you. Just jump to a weekly. Like look at this from the peaks of 2007. So we're going back a long way, and it's just been a stock which has been mostly in the avoid bin for nearly 20 years. But that's possibly changing because you can see this big support level beneath the market, which Orica started to lift itself up from in 21, had a period of sideways price action over the last couple of years, and we're just getting a breakout now. So this is one that if I'd bought that initial breakout, and this is a motion trader stock, the initial signal may have been back in December, with the moving averages cross, breaks to a new high. Not sure, but it could have been around then. Yeah, I'd be letting this one run if I was in it. If I wasn't in it, I could still consider buying it. Maybe it'd be a case of like, we've got this pullback at the moment back to the averages. I'd probably like to buy a rebound off the averages rather than just buy the dip. I'd probably be looking to buy it if it got up to probably start to clear these May highs, maybe around just above 19 might be another entry point. But for now, it'd be a hold. I'd expect if it's going to remain bullish, it should find good support above 17. So we've got the moving averages, and then we've got this horizontal support. So there should be plenty of reason to find support not too far from current levels if this is going to go on with it. But yeah, I think it's one which certainly has some potential.
All right, NTU.
Yeah, these okay, so it's one of those low price ones which has really struggled a lot over the last few years. But we do have the makings of a possible trend change with the price action now above the moving averages. So if I was in this for some reason, I'd certainly hold it and see whether this upward momentum turns into something, and I'd probably have a stop loss maybe just below the late May low, just below the 100-day moving average. Just see whether this, you'd want to see this to be bullish. It really needs to hold on to this sharp upward move it's had over the last week. So if it can start finding support near current levels, starts to track sideways, just spends time consolidating, that'd be encouraging, and that would start to create a base from which it can try and rally again from. If it were to quickly retrace all those gains and we find us back at 3.5 cents in the next couple of weeks, well, it's just been another. And this stock's been prone to this, spike up, come straight back down. It's done it before, done it many times before. So it's a serial offender of getting those who follow it excited and then not delivering. So we'll see what it does this time around. So is this a real thing? I don't know, but maybe have that stop just below where we were just talking about, below the 100-day moving average. See if it kicks on. I probably wouldn't be inclined to buy it at current levels because it's 25%. Look, if somebody wants to take a 25% risk on it, which is it's probably reasonable risk given the speculative nature of it. It's possibly a buy on this pullback on the basis that it is above rising moving averages. But as I say, highly speculative, because you can see so many times in the past we've had these spikes up, which then come back on themselves. So yeah, I'd be inclined to say the odds favour there'll be more disappointment, but I could be completely wrong. It does have that. It is possible it does get a run going and goes up a long way with 25% of risk. That might appeal to someone.
Very good. All right, now let's finish off here on ARL. And Jason.
Yeah, it was. Let me just see. Yeah, it's prone to these sharp moves as well, and then giving everything back. So I wouldn't want to buy this dip at the moment, just given its history of like strong moves, strong excitement on some sort of news release, and then the gain being given back. So if I'd bought this earlier, I'd still hold it. I'd have my wide stop on it. I'd be prepared to give back everything I'd initially made to potentially stay on board and get a much bigger gain. So I'm not interested in quickly taking a 20 or 30% rally. That's all nice, but I'll make my money from the ones which go up 100, 200, 300 and so on percent. So the 20s and 30s, I'm prepared to give most or all of that back to see whether it can turn into something bigger. So if I was on at a good level, I'd still be holding it, but it would probably getting pretty close to where I'd be calling it quits. I wouldn't be buying it at current levels because of what we just discussed. Does have a tendency to then give back gains. So I'll be going, well, look, if you buy it now, where do you put your stop loss? And you've got to have it back down here. You just kind of like, it's almost just a percentage stop rather than a structural one because we're already below the moving averages. I'd rather, if this is going to turn into something, I'd rather see if it stabilizes, see if it chops for a little bit and then starts to move higher. So I'd rather buy into strength on this one rather than trying to get the low. Maybe it's up around 75 as a buy point, but it's hard to say without a little bit more price structure. But that's how I'd play this one.
All right, fantastic, Jason. I think we're going to call it a wrap for this week then. It's been great that everyone's bought in their tickers and we had a few questions there as well. Thank you very much to everyone. And Jason, thank you very much for your expertise around these around everything basically that we speak about every week. Don't forget to go and visit Jason at motiontrader.com.au, and then you can visit us at selfwealth.com.au or you can use any of the links below, obviously, to get some free trades from Self Wealth and to get a free trial from Jason's side there. All right. Yes, Jace. Any final comments from you?
Yeah. Oh, look, it's interesting each week going through all the different stock codes and seeing. You can see, like, you can come up with a scenario for a lot of those stocks, and often, like, the first thing I'm looking at is like, how do we manage the risk around it? I think that's the way we should often look at the stock market. Think about our risk first, then look at our upside potential. I think a lot of the time, a lot of people do it the opposite. They get excited about what could happen on the upside, but then take their eye off what could happen on the downside, and then end up getting caught with the downside, going, oh, well, now I didn't expect that. Now what will I do? So yeah, look at that downside first, and if that's okay, if you think that's reasonable, then start thinking, well, now does the upside justify that risk I need to take on? And I think if you do that all day, each and every time you play the market, I think you put yourself in a better position.
Yeah. Spoken like a true money manager there, Jason. It's all about protecting your capital, which we definitely you're on the money there, right?
It's not as exciting, is it? It's not as exciting as when I
looking at how much you lose.
I see these promotions for, if you bought this, you'd now be up 500%. But okay, well, tell me, what was I risking in the first place to potentially be up 500%? I flip it. I start from the other way. What's my downside? And as I said at the beginning, if you lose your seat at the table because you run out of capital, well, you're not playing anymore. So protect your downside, then look at your upside. But all too often, I see people playing it the other way around, and it's not a way to get longevity in this business.
Exactly. All right, guys. Thanks a lot, and we will see you again next week. Thanks a lot, guys. Thanks, Jason. Take care. Bye-bye.